Leverage, margin, and liquidation. I'm sure you've heard these words in passing somewhere, maybe when you're talking to a friend and you're not quite sure what these words mean. Well, in today's video, I'm going to explain leverage, margin, and liquidation so that you can understand these concepts and you'll never be confused again. So before we get into it, I'm going to give you an outline of what we're going to cover. So firstly, we're going to cover what is leverage, then we're going to cover what is margin, and then we're going to give you an example of how leverage works, and then I'm going to explain exactly what liquidation is. So part one, what is leverage? So the way leverage works is it allows us to have more trading power than we would have just by ourselves. So what happens is the broker lends us funds so that we have more trading power. And all we have to do is put down what they call margin, which we're going to go over just now. If you were in the spot market and you had $100 in the spot market, a 1% move would only give you $1, right? But what's cool with leverage is, let's say you have 100x leverage, your $100 now has the purchasing power of 100 times 100, which is $10,000. So it's as if you have $10,000 in the spot market to use, except you're using it in the futures market. And what's key as well is that, just because you have the trading power of $10,000 doesn't actually mean that you can, that you actually have $10,000 where you can make $10,000 from your 100 initial. What it does is it just gives you the trading power of someone who has $10,000. So the best way to think of leverage is it actually amplifies your returns. So now let's move on to margin. What margin is it's basically the collateral that you put down so that you can have that nice leverage. So think of it in terms of like a rental. Think of it like a deposit fee, okay? When you move into a new place, basically you have to give your landlord extra money on the side so that if you break something, the landlord isn't the one who has to pay. They'll just take from your money and that's fine. So think of margin as like your collateral, your deposit fee that you give to your landlord so that he allows you to rent the place. So margin in the same way is like that deposit fee that you give your broker so that he doesn't have to take the losses on his side. He'll take it from you. If you do funny trades or you make any losses, it comes out from you, not from him. So the best way to explain leverage is if I just use the whiteboard and I show you. So without further ado, let's get right into it. Okay, let's start with this example. Okay, so let's say we've only got $100 in our account and we want to buy Ethereum at $1,000. We want to buy Ethereum, it's currently at $1,000. Let's just use the normal example, right? So if I had $100 in my account and I put $100 in Ethereum at $1,000, so that means if you think about it, I would be buying 0.1 Ethereum, because if one Ethereum is $1,000, then 100 over 1,000 is 0.1 E. So you'd buy 0.1 E, okay? Now, let's say that Ethereum moved up by 1%, okay? So let's say Ethereum moved up by 1%, okay? So in other words, 1% of $1,000 is 1110. Ethereum's gone up by 1%. Now, if I just had my normal account and I just had $100, then if I've put my full $100 into Ethereum, I've just made a 1% return. So in effect, what I would be making is I would be making 1% of $100. So in effect, I would only make $1. So this is without leverage. This is in the spot market. So this is just me without any leverage. This is how much I'd make. If Ethereum moved up by 1% and I put $100 of my money into Ethereum, it moved up by 1%, I would only make $1. So now let's use that same example, but now let's use 100x leverage. We're still buying Ethereum at $1,000, but now we're using 100x leverage. Now it's gone up by 1% again. So the way we'd calculate it is it's 100x, which is my leverage, okay? Then I'm going to multiply that by my 1% going up, and that will give me 100%, okay? So what I have made using 100x leverage is I've actually made 100%, okay? So what that means is it's not 100% of the $10,000 trading position that I have because of the leverage, but it's 100% of my $100. So now what you'd be trading is it would be 100% times by my 100. So I would have just made $100 because 100% of 100 is $100. So just by using leverage, I've now managed to make, instead of just making $1, I've now managed to make $100. So in effect, what you would have is you would still have your $100 that you had before, plus the money that you just made, 100. So your total account balance will be $200. So that is it's one method of calculating how much leverage does to you and how it will make you money, right? But there's another more simpler way that you can do the same equation that involves less calculations. So I'm going to show you that now. The other way of doing it, so method 2, is you have $100 that you put in times the 100x leverage. So that means that you have a trading power of $10,000. Okay, so you have $10,000. Effectively, you don't actually have $10,000, but you have the trading power of someone who has $10,000, as if they put this $10,000 in the spot market. So now, let's say that there's a 1% increase, so 1%. The way you could calculate how much you've made is you could just go 1% times my 10,000. Okay, and 1% of 10K is equal to $100. So that's the easier way of doing it. So I've shown you method 1, which is a bit more, you times it by the percent, etc., and then you still have to times it by your initial amount, or you can just go 100 times 100x. You have a $10,000 position. What's a 1% of 10K? It's $100. That's how much you make if it goes up by 1%. However, leverage is a double-edged sword. So, sorry, I'm a bad drawer, but it's a double-edged sword. So the way I like to think of it is like that guy in Star Wars who has that double-edged lightsaber. So he doesn't just have one side, he's got two. So leverage is a double-edged sword. What do we mean by a double-edged sword? What I mean by that is it can work for you, but it can also work against you. When you leverage that amount, like 100x, you are really risking a lot of money, okay? You're risking more per percentage going up, down, okay? With 100x leverage, if this price drops by 1%, you'll basically lose all your money. If we think about it, if this goes down by minus 1% times my 100x leverage, then that equals negative minus 100%. So basically you would lose all your money. This is what we call in crypto terms liquidation. So this is where now I'm explaining that concept I spoke about earlier, this liquidation. So we've spoken about leverage, we've spoken about margin, and now we're going to talk about liquidation. So liquidation is this price. So when you open up a trade, you'll usually see this price known as the liquidation price. Okay. So this price, if you reach it, you will be liquidated, your money's gone. So the key is if price reaches that point, that liquidation price. So let's draw it. So let's say we've got this liquidation price. So let's call it liquidation price. So if price comes and it reaches this point, basically we will be liquidated unless we put more money in our account. So in this case, we had our $100. We might have to put another, let's say, $10 or $20, depending on what the broker requires. So what will happen is once we start appearing here, the broker starts saying, hey, you need to start putting in more money. If you don't, I'm going to liquidate you. And let's say you don't put any money, no more money. Then once we appear at this liquidation price, basically the broker's like, thank you very much. And now your account has a nice fat zero. $0, you're broke.
You're broke! You're poor!
And that's it. So these concepts like leverage, margin, and liquidation all go hand in hand, because the more leverage you use, obviously, the more margin you require and the greater your chance of liquidation, because you are risking more. This gets applied in markets such as the crypto market. This is usually the big one, but you can also have in the futures market. And if you'd like to watch a video explaining exactly what futures markets are, you can watch that video right over there.